This week, some of the world's biggest companies are reporting earnings, and it matters more than you think. Over 20% of the S&P 500 is set to announce results, which can massively move individual stocks and even shift the broader market. Just last week, Netflix surged 13% after beating estimates, while Johnson & Johnson dropped 4%, Texas Instruments slid 7.5%, and American Express fell 3%, all because the earnings results and conference call commentary. So who's next to crash or soar? Today, I'm sharing the top 10 stocks I'm watching closely this week. That will include a quick look at last quarter's performance, their prior guidance, any recent news, and my brief stock analysis on each. Let's dive in. My name is Zach, this is Dividend Data. You should leave a like and subscribe to the channel if you enjoyed the video. While there are hundreds of companies reporting this week, I went through and picked my top 10 that I am going to follow. That includes big names like Tesla, Microsoft, and Meta, big oil companies like Exxon and Chevron, high dividend payers like the Altria Group, and high dividend growth payment companies like Visa and MasterCard. And that's just scratching the surface. If you're wondering the tool I use to keep up with earnings, it's called Earnings Hub. That is the official earnings partner of Dividend Data. In fact, it's available on the sidebar of dividenddata.com. Just click that link and it will send you straight to Earnings Hub. Here you can see all the companies reporting week by week, and you can get all of this information I'm showing today for free. However, if you upgrade to their pro plan, you can listen in live to earnings calls, get AI summaries of those calls, and in my opinion, the most important feature is their alert system. You can get notifications for unlimited tickers via text message, email, and if you download their app, notifications. So if that sounds interesting to you, click a link in the description and pinned comment of the video, or go over to dividenddata.com and click Earnings Calendar, and you'll get sent straight to Earnings Hub. So the first stock I'm going to talk about today reports Tuesday after hours. That is Starbucks, ticker symbol SBUX. Last time they reported earnings, they missed on both revenue and earnings per share. In fact, they had a 22% miss on earnings. That was the first earnings call with their new CEO, Brian Niccol. So even though they had poor results in that prior quarter, it was kind of a momentum shifting type event. They also reported that 40% of US company operated stores reported positive comparable growth, which showed some positive sign given that in prior quarters there was a lot of declining stores. But a lot of the story around Starbucks stock is based on hope that the new CEO can turn it around, because the financial results in the last quarter were not good. They were pretty much down. They had a 3% decline in revenue year over year and an overall 7% decline in comparable store sales. Earnings per share was down 24% year over year, and for the full year, GAAP earnings per share was down 8% year over year. However, they did announce a dividend increase, and Starbucks is a long-term dividend growth stock. It's a quarterly payer with a 5-year compound annual growth rate of the dividend at 8.27%. The most recent dividend increase was 7% even with this bad news. While 2024 saw negative financial performance, their payout ratio based on both free cash flow and earnings per share is still sustainable. And when you take a step back and look at the long-term view, Starbucks has still had fantastic growth of earnings per share over the past few decades. However, they're currently operating just about where they were in terms of earnings right prior to the pandemic. And the stock price actually kind of matches that. The big question with Starbucks stock is whether they can accelerate to high earnings per share growth like they had in years past. And ever since they got that new CEO, Wall Street analysts have become very bullish. They're projecting a down year for fiscal 2025, but then double-digit growth of earnings per share in the coming years. If they can hit those numbers, then Starbucks stock is set to go up. The current 2.47% dividend yield is actually historically high. However, it is not as high as what you could have gotten last July, around 3.1%. The real question is whether they can improve their total return going into the future. The past 5 years have been terrible for the stock. However, since 1990, this is a stock which has had a 35,000% total return. Now, whether that turns around soon is unknown. The company actually decided not to issue financial guidance for fiscal 2025. They say this is because the new CEO needed time to assess the situation. And there has been a lot of news. They're focusing on improving the in-store experience. They call it the back to Starbucks strategy. They've already started closing several stores, and they've been doing various promotions. So we'll see how it goes. Stock number 2 reports on Wednesday before market open. That's ASML, ticker symbol ASML. Last quarter, they beat on both revenue and earnings per share. That was a 5% beat on revenue and 7% on earnings per share. If you don't know ASML, they are one of the leaders in very high-end semiconductor manufacturing equipment. They sell these machines to semiconductor manufacturers like TSMC and Intel. And in their specific category, they have extreme market dominance. There's not really anyone close. And that has led to a pretty great business. Their earnings per share have grown massively over time, but historically demand has fluctuated with the overall semiconductor market, which often has boom and bust cycles. Last quarter was pretty good for ASML. They reported a 50.8% gross margin, and they're projecting sales growth in the quarter reporting this week. And in the last quarter, they gave outlook for fiscal 2025, where they lowered the range in projected revenue. They brought the top of that estimate from 40 billion down to 35 billion. And that's because they have very good long-term markets such as AI. But these machines are also used for more traditional things like CPUs. So it's very much a tale of two cities when it comes to semiconductors right now. They also gave guidance for slightly lower gross margins, although it's still very healthy and quality. And the stock has sold off since then because of that lower guidance. However, it still remains a highly profitable business. You can see that their revenue per share has grown at a 22% 5-year compound annual growth rate. Net income per share has grown at a 27% 5-year CAGR. However, free cash flow has fallen off since 2021. This is a dividend payer as well. They have a quarterly dividend payment, and it has shifted from being an annual payer to a semi-annual payer and now a quarterly payer. And over the long term, this dividend has grown, although it seems to have some fluctuations, which at my initial look, I'm not sure if that's due to currency fluctuations or they actually just pay different dividend amounts. And if we look at the payout ratio based on both free cash flow and earnings per share, it is sustainable. And on the bright side for ASML, we are seeing a lot of chip demand at a high level, specifically in the AI market, and mostly with NVIDIA. And to manufacture those chips, ASML's high-end machines are involved, I'm pretty sure. However, the CPU market is not good right now, and AI chip demand is expected to remain high. Recent news like the Stargate project announcement shows that a lot of new GPUs will be bought, so that means more need to be manufactured. In general, ASML will benefit from increased demand towards semiconductor manufacturers. So they want build out of new chip fabs, and they also want orders for the latest and greatest technology. For stock number 3, we have Automatic Data Processing, ticker symbol ADP, which also reports on Wednesday before market open. Last quarter, they beat on both revenue and earnings per share with a 1.3% revenue beat and 5.4% earnings per share beat. And in that quarter, they had record-breaking business bookings. ADP is a very high-quality dividend growth stock. They've been increasing their dividend payment on an annual basis for decades. And recently, that dividend growth has accelerated. The 10-year compound annual growth rate of the dividend is 12.13%. The 3-year CAGR is 13.98%. And the most recent dividend increase was 10%. It is very sustainable with a 60% free cash flow payout ratio and 58% earnings per share payout ratio. And this dividend growth is largely backed up by earnings and free cash flow growth. And while this is a company which has old industrial origins, today it is actually a software company with a subscription business model. So they have reliable growing revenue with pretty high margins with very high and growing free cash flow per share. I own ADP in my dividend growth stock portfolio, but it is my smallest position. I wish I bought way more though when I bought it because it's actually up 43% since then. Most of that was bought in summer 2023. And in the quarter they just reported, they had very good results, up 7% year over year in revenue. And in the quarter they just reported, they had very good results. For fiscal 2025, they gave guidance of 6 to 7% revenue growth and diluted earnings per share growth of 7 to 9%. And this is actually an interesting part of their business. They are a payroll company. So there's a period of time where they hold their clients' funds and they actually earn interest on the money during that time. And in the latest quarter, that increased 26% to $253 million of interest. And since then, ADP has actually been making some big moves. They acquired the payroll startup Gusto for $3.8 billion. And I've been hearing positive word of mouth about Gusto for a number of years, which in my opinion, they need to focus even more on. But overall, ADP is a quality stock and will likely continue growing, which is why it's starting to trade at a premium valuation. And then for stock number 4, I have Tesla, ticker symbol TSLA, which is reporting Wednesday after market close. Last quarter, they had mixed results with flat revenue, but a beat on earnings per share by 24%. And here you can see their expectations for revenue and earnings per share, which seem to be reasonable. Tesla is a very interesting business and controversial both in the regular world and in the world of the stock market. And the stock has actually surged massively since their last earnings, but that didn't have much to do with earnings. It actually had to do with more politics. The election of Trump basically kind of guaranteed that Elon wouldn't be seeing retribution on his companies from the US government, which definitely de-risked Tesla significantly, and the stock surged in the following days. And then there's also hopes that they'll be able to benefit from some manufacturing policies, lower regulation, and a possible federal approval of self-driving for a fully autonomous taxi network across the country. They are already planning to roll that out in 2 states. And if you're investing in Tesla stock, much of the bull case is around artificial intelligence, and in the short term, artificial intelligence related to self-driving. But the big question is how well they can monetize that. So I expect you'll see a lot of volatility in Tesla stock moving forward on the basis that people really have no idea how much that future earnings growth is going to be. They can kind of predict it with the automotive business and the energy generation business, but a lot of that self-driving taxi network and eventually the autonomous robot, that's very unknown right now. In the last quarter, they did have record deliveries for vehicles, and they remain the only profitable electric vehicle company. This has actually been a big competitive advantage for them as they can continue to lower cost. They have 19.84% gross margins as of the latest quarter, with 10.7% operating margins and 8.61% net margins. And in the automotive space, those are great margins. Their energy storage business is also growing massively, albeit in terms of revenue, it's a much smaller part of the pie right now. And this quarter was actually very good financially. They had $6.3 billion of operating cash flow, and they're reinvesting massively, a lot of which is going into new AI data centers so that they can train their self-driving models where they have a massive advantage. They spent $3.5 billion in the latest quarter on capital expenditures. And going into fiscal 2025, they're actually set up really well for growth in the coming years. They gave Outlook expecting 20 to 30% vehicle sales growth in 2025, and they're expecting the new Cybercab they launched to reach volume production in fiscal 2026. They also announced that they're planning to launch more affordable models in the first half of 2025. That's likely how they get to that high vehicle growth rate. They also just recently launched a new Model Y. This follows last year's refresh of the Model 3. And if you're analyzing Tesla stock, the Model 3 and Model Y are the main products. The Model Y is actually the best-selling car in the world, so a refresh of that vehicle is likely another way they get to that new increase in sales. But as many of you know, Tesla trades at a very high valuation, so they need massive growth in the future in order for this to make sense. Luckily, they are leaders in multiple high-growth categories over the coming decades, but there are a lot of unknowns, so I would expect volatility, especially around earnings reports like we're going to have this week. For stock number 5, I have Microsoft, ticker symbol MSFT. This was reporting Wednesday after market close. Last quarter, they beat on both revenue and earnings per share with a 1.67% beat on revenue and 6.45% on EPS. And that quarter was highlighted by very good cloud growth at 22% year over year for Microsoft Cloud and a 33% increase year over year in Microsoft Azure. In my opinion, Microsoft is one of the strongest businesses in the world. That's why it's valued at $3.3 trillion. It is the number 2 stock in my long-term dividend growth stock portfolio. I have an 86% total return. Most of that position was purchased in fall 2022. I'm really waiting for any kind of dip and may start dollar cost averaging into the company over time. You can see that their earnings per share have grown at a very high rate, and they're expected for that to grow double-digit annually. Revenue per share is going to have 15% 5-year compound annual growth rate. Free cash flow per share is going to have 14.86% 5-year compound annual growth rate. The company pays a reliable growing dividend payment with a 10% 10-year CAGR. They basically increase it 10% every single year. And this is a very sustainable dividend payment too, at a 30% free cash flow payout ratio and 24% EPS payout ratio. And Microsoft is a cash flow machine. They had $118 billion in cash from operations last fiscal year, and that's $74 billion of free cash flow. Microsoft is one of these big tech companies that's just drowning in cash. However, with AI, they have ramped up capital expenditures, and that's to build out new data centers. So their CapEx has actually more than doubled over the past year and a half. And that's actually one of the risks when it comes to investing in Microsoft. The question is how good of a return on investment they'll get with these high capital expenditures. And I recently made a video where it's like the top 5 tech stocks. And in that, I went deep in Microsoft's business. And the short story is I think this is a smart investment and they'll get a very high return on investment over the long term. The company needs to be a leader in AI. They currently are a leader in AI. And it basically fuels Microsoft's entire business. It makes their Microsoft 365 suite even better. And it helps grow their cloud business with Microsoft Azure. So Microsoft trades at a pretty high multiple, but that's deserving. And in terms of this coming quarter, I would expect pretty positive results. For stock number 6 reporting this week, I have Meta Platforms, ticker symbol META. So another big tech company. Last quarter, they were flat on revenue, but beat earnings per share by 14.86%. This is a company with multiple dominant social media platforms and is a market leader in digital advertising. They've had fantastic growth of earnings per share over the past few years, and the stock price has followed suit. And really the big time to buy was in this 2022-2023 window. Meta is actually now a dividend-paying company, and we don't know yet, but I would expect based on how much cash flow this company generates that this would be a dividend growth stock over the long term. So that would actually be pretty cool if they announce a dividend increase in this latest quarter. The current yield is 0.31%. And it's a very low payout ratio. They paid out $1.26 billion of dividends. And in that quarter, they made $16.4 billion of free cash flow. And similar to Microsoft, they're investing a ton in capital expenditures right now to build out AI data centers. But Meta's not actually in the cloud business. This is for internal use in training their models. I mean, the key financials at Meta are just staggering. The 5-year compound annual growth rate of revenue per share is 22%. The 10-year CAGR of net income per share is 38%. Free cash flow per share is a 31% 10-year CAGR and a 26% 5-year CAGR. So I actually have Meta on my watch list and may add it to my dividend growth stock portfolio. And Meta's main focus right now is AI. They're using that to accelerate their existing business. That's to improve their recommendation algorithms for users, but also to improve their matching algorithms between advertisers and users so that their advertisers can advertise more profitably on their platform. Similar to Microsoft, the only real risk right now is whether or not they get a good return on investment from their big AI spend, but their core business model is very strong right now. They gave guidance for Q4 with revenue at $45 to $48 billion, so that signals continued growth from the $40.6 billion they did in the latest quarter. For stock number 7, I have the Altria Group, ticker symbol MO. In the last quarter, they beat revenue by 3.94% and earnings per share by 2.22%. And that was driven by operating income growth in their smokable products segment. Specifically, their lead brand Marlboro is doing very strong. In my opinion, this is one of the best high-yield dividend growth stocks you can buy. The current yield is still 7.84% even after the stock price has gone up over the past year. You can see that earnings per share has increased slowly year after year, despite being in an environment where the volume of cigarettes sold is declining every year. And that's because they consistently raise prices on these products. The Altria dividend has grown at a 5-year CAGR of 4%, and they've increased it every single year for decades. In fact, these declines weren't actually from a decline. It was from spinouts of Philip Morris International and Kraft Foods. The most recent dividend increase was 4%, and I would expect continued 4% increases from here. The payout ratio is sustainable based on free cash flow with a 74% free cash flow payout ratio, and it has even now become sustainable based on GAAP EPS. In my opinion, this tricked people for a number of years thinking the dividend was not sustainable. But in reality, they just made a terrible investment in Juul and were writing down the value of that for years. But in terms of actual cash generation and free cash flow, Altria was doing fine. And that was when I bought my position, and Altria is doing fantastic for me. I have a 46% total return. It is my number one dividend payer by far. And from reinvesting those to buy more shares, my yield on initial cost basis is now up to 11.45%. And when we look at Altria's business, they have their core cash cow with their cigarettes. But they actually have 2 different growth businesses right now. They have On nicotine pouches, which in the US are basically the second competitor to Zyn. And then they have a new smoke-free vape brand that's called Enjoy. And they've been ramping up the distribution on this. And if you go to any gas station, you'll see it. They have pretty good shelf space. And just this week, the new administration removed the ban on menthol cigarettes, which should slightly help Altria. For stock number 8, I'm actually going to share 2, which will be MasterCard and Visa. I'm doing both because they're very similar businesses. And they also report on the same day. MasterCard reports before market open on Thursday, and Visa reports after market close on Thursday. MasterCard beat on revenue by 1.36% and 4% on earnings per share, and Visa beat by 1.34% on revenue and 5% on earnings per share. Both MasterCard and Visa are extremely high-quality dividend growth stocks. They grow earnings per share at a reliably high rate. Visa has grown its dividend payment at a 17% 10-year compound annual growth rate. Their most recent dividend increase was 13.4% and 15% prior to that. And this is very sustainable with a 22% free cash flow payout ratio and 21% earnings per share payout ratio. Visa has seen their revenue grow at a 16% 5-year CAGR. Free cash flow per share has grown at a 15.98% 5-year CAGR. And both of these have wildly high margins, 80% gross margins, 55% net margins. Visa is the top stock in my dividend growth stock portfolio. I bought the majority of my position in early 2024. I have a 31.17% total return. It's my 4th highest dividend payer. I reinvest all my dividends, and I look forward to that growing 10 to 15% a year. Now, if we look at the latest quarter for both Visa and MasterCard, You can see they both had great growth year over year. MasterCard does grow slightly higher, but they trade at a higher valuation as well. But both are seeing double-digit growth. But Visa, since they're the larger business, they're actually seeing larger scrutiny from the Department of Justice. There's currently an ongoing lawsuit saying they have anti-competitive practices. I would suggest that's subject to change given that we have a new administration. And these two companies run the largest digital payment networks, and they're very good businesses with a wide competitive moat in terms of their network effects. The main risks for them come from regulation, and there's also some minor risks around crypto when it comes to using stable coins and kind of bypassing the fees that Visa and MasterCard put on their transactions. But I actually think that's probably less likely because those fees, a lot of that actually goes into funding incentives for these credit card companies that issue the cards. And as long as consumers choose to use those kind of credit cards, they will probably pick the ones with the best rewards, and you need fees in order to have good rewards. And there actually is some risks. You have their new AI and crypto czar, David Sachs, who I actually am a big fan of David Sachs, actually. But he has actually spoken specifically about the fees from Visa and MasterCard and trying to use innovation in crypto as a way to bypass those fees. But we'll see what happens. I'll be sure to cover if there actually is some major news that would impact Visa or MasterCard stock. For stock number 9, I have Apple, ticker symbol AAPL. They also report Thursday after market close. Last quarter, they were flat on revenue expectations and beat earnings per share expectations by 2.5%. However, Apple stock has actually sold off significantly over the past month at 11.67%. And in my opinion, that sell-off was deserved. Apple was probably the most overvalued big tech stock, given that they were trading at like a 40 PE multiple, while they've had practically no growth over the past year or two. And there's no clear line of sight into high growth for Apple. The iPhone has mostly plateaued, and all of the growth is coming from services at this point. And when I say this, I'm talking about raw revenue numbers. Revenue has been flat since fiscal 2022. However, on a per share basis, it does look like there has been slight growth, with a 3-year CAGR of 5.18%. But that's only because Apple kind of juices the stats. They have massive amounts of cash flow, and they pile all of that into share repurchases. They are buying back around 3% of their shares outstanding every year. That's $100 billion of free cash flow, with nearly $100 billion going to share repurchases. Now, don't get me wrong, Apple is still one of the best businesses in the world. They have great margins. They still generate tons of free cash flow. But people are starting to look around and say, where is the growth going to be for Apple in the coming years? I haven't bought any Apple stock in like 3 or 4 years at this point. I have a good return on what I have bought. I'm up 83.5% overall. And I'm not planning to sell my position just because Apple is such a dominant business. And in my opinion, they have a very wide economic moat on their existing business. The question is really just future growth. Apple pays a dividend, but it's a pretty slow growth dividend. The 5-year compound annual growth rate is 5.37%. They increased it about 4% a year recently. But in the grand scheme of things, this dividend is a very low payout ratio for the company, 14% based on free cash flow. Most of that money, as I mentioned, is going towards share repurchases, which is another key way that a company can return capital to shareholders. And unlike other big tech companies, Apple is not investing into AI. They have kept their CapEx very constrained, and they're largely taking the wait and see approach and just slowly rolling out some of the benefits into their software. For example, Apple Intelligence just launched, and it's kind of lackluster. A lot of the features are very passive, like they summarize notifications and things like that. Better recommendations and autocomplete for typing. Siri has gotten a lot smarter, so it's helped improving the iPhone as a product. But it doesn't seem like that has translated to sales yet. The only real new revenue Apple's getting from AI is their deal with OpenAI, where they're kind of paying to be like the exclusive partner. If you're bullish on Apple, you have to be bullish about their services business. That's the only one that's growing consistently at a high rate. They just hit an all-time record revenue in the latest quarter of $25 billion, which was a 12% increase year over year. And in their guidance, they said that they're expecting service revenue to grow at a similar rate in 2025. And for this next quarter, overall, they're expecting low to mid-single digits growth. And then for stock number 10, I'm going to do another combo pick with ExxonMobil, ticker symbol XOM, and Chevron, ticker symbol CVX. So the two big oil giants. Both of these report Friday before market open. Last quarter, Exxon missed revenue by 4.18% and beat earnings per share by 2.13%, while Chevron beat both of them by around 3%. And I'm going to discuss both of these because the dynamics of their business are very similar. If you want to know how they're going to do in terms of earnings, just look at what the price of oil was in that last quarter. So based on that, I would expect their earnings to be pretty similar to what they were in the prior quarter. And this is a very profitable level where they are printing money. Not like 2022, where it was insane numbers. The last quarter, ExxonMobil generated $11 billion of free cash flow. And what I really love about ExxonMobil and Chevron is that they continue to pay and grow their dividend throughout any oil environment. And that's because they build up a very strong balance sheet so that they can weather any kind of oil market. They have a strong cash position with $26.9 billion in cash and short-term investments, and that debt has been lowered significantly to $15.5 billion, much lower than those 2020 highs of $61 billion. Yeah, and Exxon continues to grow their dividend payment over time. The 3-year CAGR is 4%. The most recent dividend increase was 4.2%. And if they stay around these profitability levels, they'll have about a 40 to 50% payout ratio. In my personal dividend growth stock portfolio, ExxonMobil is my 4th largest position, and it's actually been my best performer with a 222% total return. It's my 2nd largest dividend payer, and from reinvesting dividends, my yield on initial cost basis is now up to 11.77%. You heard me right, even though the current yield is only 3.64%. And the reason why is I bought my ExxonMobil stock in 2020 when we were in a horrible oil market. So bad that ExxonMobil was actually losing money. People were worried about a dividend cut, but I knew they had a strong balance sheet and that the price of oil was going to recover as soon as we reopened the economy from COVID. And right now I wouldn't say is the best time to buy Exxon or Chevron stock. And that's because I'm predicting that the price of oil is going to go down in the coming years. While demand may be higher, supply is expected to increase significantly, especially with Trump's energy policies. So that will hurt the margins of oil producers like Exxon and Chevron. That said, they will still do very well over the long term and will likely remain profitable. And both of these companies are actually investing into new production as well. But if you want to know what I think the top energy stocks are, I just made a video where I went over the top 5 energy stocks to buy. That will be linked at the end screen of the video, so go watch after you finish this up. So when Exxon and Chevron report earnings on Friday, that's an earnings call I might actually listen to, and I'll definitely read the summary to see what they have to say. I'm curious what they're going to say about the Trump administration policies, the possibility of lower oil prices, and how they're planning to deal with that. And by the way, this week, if you're a user of dividenddata.com, you can use our AI analyst to summarize all of these earnings calls right as they happen. Our stock analysis tool will update with the data. And if you want to sign up and use this tool, which I showed throughout the video, sign up at dividenddata.com. We currently have a 7-day free trial if you use the link in the description and pinned comment of the video. And if you want to track your earnings like I do, then head over to Earnings Hub. This is the official earnings partner of Dividend Data. And if you want to try it out, make sure you use the link in the description and pinned comment of this video. That way they know we sent you. Thanks for watching, and I'll see you in the next video.